Good afternoon, everyone. Today we're talking about the One Big Beautiful Bill Act, and hopefully going to cover some things that you might know already, but also breach into some territory that you may not know. Before we get started, let me introduce myself. So, seeing my picture on the screen reminds me that I should tell you all the same thing that I tell my wife every morning. I'm sorry that I'm not better looking, but you don't love me for my looks. You love me for my tax knowledge and my economics expertise. Say that to my wife every morning, and to which she always replies, "That's true. I do love you for your tax knowledge and your economics expertise, but couldn't you also be better looking?" Well, I'm sorry about that, but let me tell you about my background in taxation economics. I work for LBMC, which is an accounting firm. I am not an accountant. Instead, I'm an attorney. I'm a tax attorney. I have my JD and tax LLM from Washington University in St. Louis. Additionally, I have a master's degree in economics from the London School of Economics, and I've been a practicing tax attorney for the past 20 years and a economics professor, an adjunct professor of economics at Washington University in St. Louis for 15 years. My practice at LBMC focuses on strategy, structures, mechanisms for estate planning, business succession planning, business structures, everything of that area. So let's talk about what we're going to talk about today. In reviewing the One Big Beautiful Bill Act of 2025, we must start our conversation with the Tax Cuts and Jobs Act of 2017. So we're going to review that first. Then we're going to examine how the One Big Beautiful Bill Act affects the Tax Cuts and Jobs Act of 2017. We're going to review key provisions and new provisions of the One Big Beautiful Bill Act. And then I'm going to spend just a little bit of time talking about the spending cuts and the current government shutdown that has resulted from these spending cuts that are contained inside the bill. There will be time for questions at the end. Please do follow through and put your questions into the question and answer area, and Maris will ask me all those questions at the end. As a quick disclaimer up front, the One Big Beautiful Bill Act is in fact quite big, so I will not be able to cover everything that is contained in it. I'm going to try to give a high-level review of it with some of the key provisions. There's going to be a lot of stuff I won't be able to cover in the hour that I have today. So I'd encourage everyone to seek out the LBMC blog, where we have a considerable treatment of the One Big Beautiful Bill Act up on our blog, as well as an upcoming Navigator newsletter will contain a large article on the One Big Beautiful Bill Act. All right, so let's dive into the Tax Cuts and Jobs Act of 2017. So, the end of the first year of the first Trump administration, in December of 2017, the Republican Congress and Donald Trump, the new Republican president, signed into law the Tax Cuts and Jobs Act of 2017. As a general matter, and we're going to see this play out in a few minutes, the Tax Cuts and Jobs Act of 2017 was first and foremost a corporate tax cut. At the time, the United States had a corporate tax rate that reached up to 35%. And believe it or not, that was the highest corporate tax rate in the OECD, the Organization of Developed Countries. Our corporate taxes were higher than those of France and England and Italy and all the rest. And it led to a period, especially during the Obama administration, of corporate tax inversions. These ideas where American businesses would try to leave the United States as a tax jurisdiction through a number of different structures. And this led to a lot of American value being offshored. So the Tax Cuts and Jobs Act of 2017 was an attempt to deal with that high tax rate to allow more American value to come back into American shores. It also had time-limited deductions for individuals. There were tax cuts for individuals, but we're going to see that those were time-limited in a few minutes. And those were all set to expire on January 1st of 2026. So corporate tax cut, which we'll see is permanent, and then a bunch of individual tax provision changes that were set to expire. Let's take a look at the scorecard. Now, before I go to the next slide, I'm going to show you three different scorecards that show the way that these taxes have developed. We might be able to get you a copy of my PowerPoint presentation at the end of the presentation, but I'd also encourage you, these scorecards might be useful. So if you have a snipping tool or the ability to screenshot, I'm going to give you 10 seconds at the end of each scorecard as a chance to screenshot. All right, so first let's look at the Tax Cuts and Jobs Act of 2017 and what effects it had across a number of different tax provisions. First, for the corporate income tax, it lowered the corporate income tax from a graduated rate up to 35% to a flat tax of 21%. There was some talk of trying to lower that to a flat tax of 15%, but they weren't able to get there, so it came out as a flat tax of 21%. At the same time, realizing that S corps and partnerships weren't getting a tax cut to the same degree as C corps, Congress created the new qualified small business income deduction, what I know is Section 199A, but a 20% deduction for pass-throughs for qualified income. Also, the top individual tax, the individual rate brackets were lowered. Notably, the top individual rate was lowered from 39.6% down to 37%. The standard deduction was increased, nearly doubled, from $12,700 for married filing jointly to $24,000. Here's one of the areas where taxes were not lowered for individuals: the state and local tax deduction. Prior to the Tax Cuts and Jobs Act of 2017, a person could deduct all their state and local taxes against their federal income tax burden. But then starting in 2018, that was capped at $10,000 per year of state and local taxes paid. Similarly, the mortgage interest deduction was somewhat limited from what was previously $1 million of acquisition debt. So if your mortgage was $1 million, you could deduct all the interest. And now it's limited to $750,000 of acquisition debt. That came down. The gift and estate tax base, the gift and estate tax exemption base, was doubled from $5 million indexing with inflation upwards to $10 million indexing with inflation upwards, allowing high net worth individuals to estate plan and leave far more value to the next generation than they could previously. The personal exemption was eliminated. The child tax credit was doubled, and there's a higher phase out for it. The alternative minimum tax exemption was raised by almost 50%, large increase there, and it had a higher phase out for when that AMT exemption would no longer be allowed. Miscellaneous itemized deductions, these over 2% of AGI deductions that used to be around pre-2018, those were all eliminated. Alimony paid by people at divorce used to be deductible, no longer deductible after the Tax Cuts of 2017. Moving expenses used to be deductible for qualified moves, now no longer deductible except for the military moves. And the Affordable Care Act used to have an individual mandate that had a penalty applied to it. If you didn't have insurance, you had to pay a penalty with your taxes every year. Big portion of the Affordable Care Act. Well, in 2017, the Tax Cuts and Jobs Act reduced that penalty to zero. So ostensibly, the provision is still there, but the penalty has now been set to zero. I'm going to give you just a few seconds to take a screen capture or a snip of the screen. These scorecards might be useful as a quick reference to see how taxes have changed. All right, so let's push on. As we can continue to consider the Tax Cuts and Jobs Act of 2017, it is important to reiterate that the corporate tax cut, that 35% down to 21%, that was permanent. But all other tax aspects of Tax Cuts and Jobs Act of 2017, those were temporary. They were set to sunset on January 1st of 2026 because of the Senate rule called the Byrd Rule. The Tax Cuts and Jobs Act of 2017 was able to be passed without a filibuster-proof majority under a provision called reconciliation. But because of reconciliation, they could not increase the deficit over 10 years beyond a certain point. And so a lot of the tax cuts would have too much of an impact on the federal deficit. And therefore, they had to be time limited. Those time limitations meant that starting on January 1st, 2026, because of the Byrd rule, this old Senate rule about deficits, they had to be temporary. Let's see how this plays out on the scorecard as well. So now we see how things looked before 2017, how things looked starting in 2018 with Tax Cuts and Jobs Act. But how were things, if they were just left to their own devices, what would happen on January 1st of 2026? That's the rightmost column here. And if there was no intervening acts by Congress, the right column shows what happens with that sunset. So first, the corporate tax rate cut, as I mentioned, 21% down from 35%. That is permanent. That remains whether Congress acted or not. But the pass-through deduction for S corps and partnerships, that goes away. The individual rate brackets go back to their pre-Tax Cuts and Jobs Act rates, including a top marginal rate of 39.6. At the same time, the standard deduction comes back down to its 2017 levels, although it would be adjusted for inflation, so it would go up, but it would come back down to its prior base. The state and local tax deduction would become unlimited again, and the mortgage interest deduction would have a higher rate of acquisition debt allowed for it. The estate and gift tax exemption would come back down to their pre-Tax Cut and Jobs Act level. Those index heavily with inflation, so that would be about $7 million in 2026. Personal exemptions reinstated and inflation adjusted. The child tax credit comes back to its $1,000 credit, but with a lower threshold for when that credit's no longer available. The AMT exemption comes back in at its lower rate, although, again, that is also inflation adjusted. We reinstate the miscellaneous itemized deductions. Alimony, strangely enough, as part of the deficit reduction, alimony remains non-deductible. That was a measure to help offset some of the deficit concerns that the Byrd rule raised. So it doesn't look like you're ever going to be able to deduct alimony again. Moving expenses would be reinstated, and the Affordable Care Act individual mandate would remain at zero. So I'll give you another few moments just to take a screenshot of this if you want to see what would have happened in 2026, but for Congress intervening. This is the way the Tax Cuts and Jobs Act of 2017 was intended to play out under its own terms. A permanent corporate tax deduction and temporary temporary tax alterations for individuals more or less across the board. Okay. So there's this looming sunset coming on January 1st, 2026, when more or less taxes are going to go up for everyone, all individuals, with some offsetting changes in deductions like state and local tax or mortgage interest deductions that might mitigate some of that. But largely, this is going to be a tax increase for individuals. However, that sunset could be prevented by an act of Congress. And that's where we get to the One Big Beautiful Bill Act. On January 4th, 2025, President Trump signed into law the One Big Beautiful Bill Act. If we're going to be technical, this is Public Law 119-21, and its proper name is an act to provide for reconciliation pursuant to Title II of the House Congressional Resolution 14, House Conference Resolution 14. The One Big Beautiful Bill Act was the short title of the bill, but in the final version that was passed by the Senate, it was stripped. It was no longer allowed. I don't know if it was thought to be too Trumpian or what, but the One Big Beautiful Bill Act name was in fact taken out of the bill when the Senate finally passed it. And yet it's stuck. Everybody sort of knows it as that One Big Beautiful Bill Act. So OBA for short, is what was passed by Congress, even though they didn't call it that name. It is First and foremost, a extension of the Tax Cuts and Jobs Act of 2017, but it does add some new provisions. I'm going to talk about some of those on the individual side and mention just briefly some of those that may also occur across the board for businesses as well. All right. Now that we have the One Big Beautiful Bill Act, let's check the scorecard again. Instead of things expiring in 2026, now let's see how OBA, the One Big Beautiful Bill Act, affected the tax changes from the Tax Cuts and Jobs Act of 2017. First, as always, and this needs to stick in your brains, the corporate tax rate cut from 35% to 21% has and always will be, until Congress changes it sometime in the future, been a permanent aspect of the Tax Cuts and Jobs Act. Ooh, I think I just lost something here. Oh no, I'm tracking speech. Okay, now I don't think I'm doing that anymore. I think I create closed captions on my screen. I apologize for that. So now, corporate tax rate permanent at 21%. That 20% deduction for pass-throughs for S corps and partnerships, that has been extended. That is also now permanent. That is permanently part of the tax code. 21% the 20% deduction for qualified small business income, Section 199A. We'll say more about that in just a few moments. The individual rates have been set to their Tax Cuts and Jobs Act level, which means the top marginal rate is 37%. The standard deduction continues its inflation trend from the Tax Cuts and Jobs Act in 2026. It's going to be $31,500 for married filing jointly, or $15,750 for singles. The state and local tax deduction had its cap raised from $10,000 to $40,000. And we'll come back around and look at that again in a moment as well. The mortgage interest deduction acquisition debt has remained limited at $750,000. The estate tax exemption has been made permanent, set at $15 million to start, and it increases upwards with inflation. $15 million would have been about the inflation adjustment of 2026 anyway, if the Tax Cuts and Jobs Act were to move in a straight line. But they decided to reset that at $15 million and make that clear, and then inflation adjusted after that. Personal exemptions are still gone. They're not part of the tax code anymore. The child tax credits, not only are they still at the higher level of $2,000 per child, but now they adjust upwards with inflation, and there's a higher cap for income levels before they phase out. So those have been made quite a bit more generous. The AMT exemption was set at $140,000, which again is about in line with its Tax Cuts and Jobs Act inflation adjustment trend, but there is a faster phase out of incomes now. And we'll look at that a little bit more in just a moment as well. Miscellaneous itemized deductions are still gone. Alimony, still not deductible. I don't think that's ever coming back unless there's a major act of Congress sometime in the future. Moving expenses, still not deductible unless you're in the military. And the Affordable Care Act mandate, the penalty remains $0, and some new restrictions have been added to availability of the Affordable Care Act. We'll talk about those near the end when we talk about some of the spending cuts built into the One Big Beautiful Bill Act. I'm going to give you just a moment to screen capture this if you're interested, and then I'll move on. All right, I would like to highlight some of the provisions that I think that we've seen on this scorecard that I think deserve a little bit more discussion and consideration. Number one, let's talk about this pass-through deduction, this 20% deduction for S corps and partnerships that was going to be gone on January 1st, 2026. The One Big Beautiful Bill Act makes it permanent. All right. This was always going to be an issue when back in 2017, Congress cut the corporate tax rate from 35% down to 21%. That cut meant that C corps that operate in the arena alongside S corps, they both compete in the marketplace against each other. That C corps would get this huge tax cut from 35% down to 21%, and that would be permanent. Well, their S corp competitors, how do we compensate them? How do they, in fact, get to be put back on some level of parity with C corps? If you cut C corp taxes and you don't provide for S corps in some sort of similar way, well, you're going to give C corps an advantage in the marketplace. And I would predict that if there was not an extension of this 20% deduction, you'd see a lot of companies shifting to the C corp structure. Now with the 20% deduction, it's made permanent. They are brought back into some amount of parity. But there is something I want to point out with this, especially with the 21% tax for C corps. We have this instinct in our brain. We all know that C corps face double taxation and S corps face single taxation. And we have this instinct that says that, well, one is less than two, single tax must be less than double tax. Therefore, S corps must be at a lower total tax than C corps, right? Well, it depends. Sometimes they are, and in some circumstances, they're not. And there's actually an inflection point that I can demonstrate to you where they are or are not. And I think this is worth a little bit of consideration here now that the 20% deduction has been made permanent. Let's run through $100 of income to a C corp and $100 of income to an S corp that's taxed at the highest marginal rate for individuals. So with a C corp, you have $100 coming in as your gross income. It faces the corporate tax of 21%, leaving $79 of value inside the corporation after taxes are taken out. That $79, if we're going to pass this all the way through to the shareholder, and this is the title of this slide is Compare Taxes on Distributions. If we're going to pass all this through to the shareholder, this is where we get to the second level of tax. Qualified dividend tax, 20% to same as long-term capital gains for qualified dividends, plus a 3.8% surtax from the Affordable Care Act, leaving a total to the shareholder of $60.20, or an effective tax rate of 39.8%. Let's consider the same $100 made in S corp with a 20% deduction available for it. The gross corporate income is $100, just like on the other side, but we take away 20%. We take away $20 from that analysis for that deduction, leaving $80 of taxable income. That $80 of taxable income is now taxed at the highest individual tax rate, as I said, for comparison's sake, 37%, leaving $50.40. You may have to trust me on the math with this, $50.40 after tax. If we then add back the 20% that is not taxed, we add that back to the total amount that's available, it leaves us with $70.40, a effective tax rate of 29.6%. So on distributions, it is true that S corps, if you distribute 100% of your earnings through to the shareholders, S corps with that 20% deduction will be in a better position than C corps. However, it is not always necessary to distribute 100% of your earnings. Many corporations will retain their earnings. And here, when there is no dividend on the C corp, we see that C corps actually have a lower tax rate on retained earnings. 21%, the C corp level with no dividend tax versus 29.6% for everything, regardless of distribution, regardless of flowing the proceeds through to the taxpayer. The taxes all flow through the S corp to the taxpayer. So here, the C corp does have a better tax position. What this means is, especially since 2017, and especially in light of the One Big Beautiful Bill Act, it has become incumbent on corporations to actually examine how much money they intend to distribute out to their shareholders on an annual basis. If the answer is 100%, then yes, the S corp is probably the better structure. If the answer is zero, we're going to retain all earnings for whatever reason. We're going to do it like Berkshire Hathaway. Then the answer is probably a C corp is a better structure. And what's interesting is we can mathematically determine the amount of where the crossover point comes, and that crossover point appears to be about the dividending out of 45.6% of retained earnings for a C corp. If they dividend out 45.6% of earnings or less, the C corp is going to face a lower marginal tax than the S corp. If they dividend out, and that 45.6% of retained earnings is 36% of gross earnings, of the total gross income of the C corp. The C corp will be better off if they dividend out less than 45.6% of retained earnings. This is an analysis that the accountants here at LBMC have been performing for their S Corp clients and C Corp clients. If you are concerned about this at all, I'd encourage you to reach out to LBMC and we can run through this analysis with you. All right, let's talk about another important aspect of the scorecard, the state and local tax deduction. The state and local tax deduction, for a guy who lives in the tax world as I do, this is the best example of a political football that I've ever seen. It kicks back and forth. In 2017, this was sort of a match between red states with lower taxes and blue states with higher taxes, with the argument being that states with lower taxes, such as Tennessee, with no state income tax, we are subsidizing the federal government for the benefit of those in states with higher taxes, like New York and California. We are paying proportionally more to the federal government because we don't have this deduction available to us in any meaningful way. And they can deduct massive amounts of state taxes. And that argument won the day in 2017. And the cap of $10,000 was put in place starting in 2018. Well, the political football changed the other direction. And it wasn't that in 2025 for the One Big Beautiful Bill Act, it wasn't necessarily that the Trump administration or the Republicans from red states needed Democrats to help pass the One Big Beautiful Bill Act. That could pass with reconciliation and the Byrd Rule again. What it didn't mean, however, was that blue state Republicans needed to get something back for this. That if they were going to go back to California and New York as Republicans, they needed to get some sort of victory on state and local tax deduction that they could show off to their constituents, lest they might lose their office. So the negotiation internal to the Republican Party was between red state Republicans and blue state Republicans, and the compromise they seemed to come to was this $40,000 deduction cap. It's now raised. $40,000 in state and local taxes should cover most taxpayers in most states, even high tax states, one would hope. But that was the new deduction. The blue state Republicans were threatening just to prevent the One Big Beautiful Bill Act from passing altogether, because then they'd revert back to unlimited deduction, and that would be a victory for them in their districts. So this was the compromise they came to. The state and local tax deduction with its higher cap, not terribly valuable in low tax states like Tennessee, excuse me. However, I will tell you that you can still deduct property taxes and sales taxes actually paid, and there are tables that can help you with the sales taxes on your 1040. So it's not meaningless to us in low tax states, but definitely has a higher benefit to those in higher tax states. What else should we talk about? Let us look at the estate and gift tax exemption a little bit more closely as well. So the estate and gift tax exemption, this is something that has been controlling my life for the past 2 years. I do a lot of estate planning with LBMC. I do a lot of conversing with high net worth individuals. And I used to run a program at LBMC called the 2026 Initiative, Imperative Tax Planning. And it was this idea that high net worth individuals needed to use their full exemption before they lose it. In 2026, the exemption was going to be cut in half from $13.99 million, where it is in 2025, to about $7 million. And if you used it, that'd be grandfathered in. But if you didn't use it, it would simply disappear into the ether. So there were a lot of estate planning structures, such as spousal lifetime access trusts. In fact, SLATs, that's what those are called. SLATs are big for securing your lifetime exemption in fear that it might go down. And I have helped numerous clients secure SLATs. Well, One Big Beautiful Bill Act permanently put in place the $15 million exemption from the estate and gift tax and allows it to index upwards with inflation. And it's permanent now. This took away some of the frenzy, some of the feeding frenzy for estate planning that looks like it might start in the latter half of 2025. In fact, estate planners across the Nashville area, across Tennessee and Kentucky, were getting ready for just a deluge of people who waited until the last minute to try to take advantage of their estate tax exemption. And whether thankfully or not, depending on who you are, the One Big Beautiful Bill Act made that permanent. So it stopped that feeding frenzy. It effectively killed the 2026 initiative, but that's okay. And now we are in a much more stable place for estate planning. There's not that rush to get your estate planning done. All right, one more thing from the scorecard let's focus on, and that is the AMT exemption, the alternative minimum tax. All right, the AMT is this special secondary tax that's designed to prevent high earning individuals, people with high incomes, from avoiding a substantial share of tax by way of taking numerous and substantial deductions. It's meant to hit millionaires and billionaires with a secondary tax that eliminates a lot of their deductions. We run both analyses simultaneously, and whichever tax is higher, that's what you pay. But the AMT has a substantial exemption for it. What was $84,500 in 2017 and $109,400 starting in 2018, that is supposed to prevent most people from having to pay the AMT. But starting in 1990 and continuing upwards into the 2010s, there was substantial what we call bracket creep, which means that the AMT exemption, though it increased with inflation, did not increase fast enough to match the increase in earnings, which means that during that 20-year period, more and more and more and more people had to start paying the AMT. And it started catching people that it was never designed to catch. Well, this was a problem, and the Tax Cuts and Jobs Act put in place this new $109,400 exemption with a phase out of that exemption for incomes above $1 million. Now the AMT was rendered practically toothless. And I'll show you this on the next slide. The OBBA, the One Big Beautiful Bill Act, comes around and works to find a compromise. It is trying to prevent the AMT from being utterly toothless like it was under the Tax Cuts and Jobs Act. But it doesn't want to create the bracket creep, which we'll see in just a second on the next slide, that existed before 2017. So what they did was they allowed the exemption amount to continue on its trend, but now the phase out of that exemption is much more rigorous. It occurs at a lower level and occurs much faster. So this is a representation of the alternative minimum tax and the number of taxpayers that pay it in millions on the left side of the graph, as analyzed by the Tax Policy Center. And what you'll see here is from 1990 through 2018, 1990 through 2000, it really looks like 2006, 2007, there's that bracket creep where more and more people are paying it. And that bracket creep's also really shown if you see the amount that's collected under the AMT. But starting in 2018, Tax Cuts and Jobs Act just hobbled it, just went away. The exemption was so generous and the phase out was so relatively toothless of that exemption that practically nobody was paying the AMT for the past 7 or 8 years. Well, and what you see here is the Tax Policy Center assuming that OBA doesn't pass. This is what happens if that sunsetted out. So that's not really the case. I have not yet seen the Tax Policy Center do an analysis of the AMT with OBA, but my own estimates on the screen with that red line. This idea that it would probably revert to trend that was from 1990 till about 2002 before it spiked upwards. It would probably revert to a more gradual trend upwards and probably need to be re-examined in the future. But the OBA does allow for a big exemption from the AMT, but a more rigorous phase out of that exemption. Okay. OBA, in addition to extending everything that the Tax Cuts and Jobs Act of 2017 put in place for individuals, in addition to extending those provisions, many of which we just looked at, it also put in place new items that are kind of an awkward fit, if I'm going to be honest. But these are items that President Trump, when he was the candidate in 2024, promised on the campaign trail. These are Trump from the stump promises that got put into the One Big Beautiful Bill Act. They are you'll see right away what the promise was and what it was aimed at, but will also show that they have varying degrees of effectiveness. So number one, this overtime deduction. Overtime deduction was promised by Trump on the campaign trail that if you make overtime, there'll be a deduction for your overtime. Yes, that's true now. The One Big Beautiful Bill Act does contain an overtime deduction, but it has restrictions. First, it applies only to the premium portion of overtime. That is when you have time and a half. It applies to that extra half. It doesn't apply to your base wage for overtime. There's also a maximum deduction of $12,500 for single filers, $25,000 for married filing jointly. And then, as we're going to see with all of these new deductions, there's a phase out with a modified adjusted gross income, which means that once you have a single filer hit $150,000 or a married filing jointly hit $300,000, the value of the deduction starts to go away, and it disappears entirely when you have a single filer reach $275,000 and a married filing jointly hit $550,000. This applies to tax years 2025 through 2028 only. So it has a new bird rule requirement for limited time period. So it only applies for a very limited period of time. And it's one that Congress could extend with another future act of Congress, but we'll have to see if this plays out to be in something that is politically clamored for or not. By the way, your overtime, even that premium portion, still subject to Social Security, Medicare, Medicaid, FICA, as well as the state and local taxes. So you're not off the hook on your overtime pay entirely. Also promised by Donald Trump on the stump was tip deduction. Eligible employees may deduct qualified tip income with an above-the-line deduction. When I first heard about this, I was really excited. I decided I was going to put a tip jar out on my desk here at work, and anytime someone came in to ask me a question, I just jangled the jar at them and not answer their questions until I put a nice $20 bill in it. All tax-free, right? Well, I'm afraid not. So again, this tip deduction is part of what's on the stump, but may not be quite as good as it looks. There are severe restrictions on it. Number one, tips have to be those earned in an occupation that customarily and regularly receive tips. Wait staff at restaurants, concierge staff or bell staff at hotels, things like that. The IRS has actually put out a list of what jobs qualify. And I don't think that I can somehow shoehorn tax attorney into those jobs unless I start serving tables here at work as well. Only voluntary tips will qualify. Mandatory service charges, that mandatory charge of 20% for tables eight members or bigger at a restaurant, those may not qualify under this. Also time limited. We're going to see all these time limits, 2025 through 2028. The maximum annual deduction, $25,000 worth of qualified tips. The deduction is limited based on adjusted gross income, starts to phase out at $150,000 for singles, $300,000 for married filing jointly, gone altogether at $400,000 for singles, $550,000 for married filing jointly. Tips remain taxable for Social Security and Medicare and Medicaid. State and local taxes may still apply to tips. The last time I was in a tipped profession was about 20 years ago. And it's one where we, if tips came in cash, it was a question of how much do you report. And this is something that's very interesting because to get the deduction, you have to report 100% of your tips. And I'm not in telling people to avoid tax by not reporting their tips, but that was a question that we had for tips previously. And now it's going to be this interesting calculation of how much of the deduction do you want and how much do you want to not report on your tip reports at the end of every shift. Two more. So number one, seniors deduction. So Donald Trump came out promising no more tax on Social Security. Well, before the Tax Cuts and Jobs Act, before Tax Cuts and Jobs Act as well as before OBA, not all Social Security was taxed anyway. The tax on Social Security for people under a certain income level was only 50% of the Social Security benefits. For anybody above that income level, it's 85% is taxable of your Social Security benefits. But Trump came out and said no tax on Social Security. Well, that was going to be hard to work out. So what Congress came up with instead was this new seniors deduction. It's an additional standard deduction available for seniors, $6,000 for singles, $12,000 for married couples, where both couples qualify. You have to be age 65 and above to take this new deduction. This deduction phases out again, and it phases out reasonably quickly at $75,000 of modified adjusted gross income for single filers, $150,000 for joint filers. Eliminated at $150,000 for singles, $250,000 for joint filers, and again, only effective from 2025 through 2028. There's going to be a lot of looking at these individual provisions and see just how much impact they have, who's using them, to what extent, and what kind of political reverberations they create. But this is the seniors deduction. Got one more to go through, and then we're going to talk about some spending cuts. The auto loan deduction. I recently spoke very briefly at the Tennessee Automotive Association talking about this. This is a new above-the-line deduction for auto loan interest. You don't have to itemize to take advantage of it. It says essentially you may deduct your interest off of an auto loan a lot like you deduct your interest off of a mortgage, off of a home loan. But of all the ones I just went through, of the tip deduction, the overtime deduction, the senior deduction, this one probably is going to be the least impactful, other than a psychological impact when buying a new car. So the deduction is capped at $10,000 per year. In my mind, that's not a big restriction, because how do you get to $10,000 of interest on a car loan? That would imply that you bought $100,000 worth of cars at a 10% per year rate. That is pretty high. So that $10,000 per year cap, that's not going to be the big cap. Applies again only in 2025 to 2028. But now here, look at this. Applies to new cars only. I have bought new cars in my life, but I tend to get certified pre-owned cars. That's just who I am. New cars only. Those new cars must have their final assembly in the United States according to their VIN number. And here's the big kicker. The modified adjusted gross income limit is really rather low on these. If you're talking about people buying new cars, single filers, it starts to phase out $100,000, married filing jointly $200,000, no deduction after $150,000 for singles, and after $250,000 for married filing jointly. How many people under those thresholds, especially how many people are going to buy, earning under $100,000, are going to buy new cars and have a substantial rate of interest on those loans? Some, probably, but I think the new car requirement and the income phase outs make this one relatively toothless when it comes to a deduction. On the other hand, something that OBA also removed to compensate for this was The EV tax incentives, the $7,500 for the purchase of electric vehicle, they expired. Actually, they expired 6 days ago. This is from my. They expired right at the end of September. Um, and if you're going to put in place an alternate fuel vehicle refueling property credit, if you're going to put into place a charging station in your home, there used to be a credit for that, but that now expires on June 30th, 2026. So this auto loan deduction may not have a lot of teeth and is taking the place of some EV deductions that were quite beneficial to people who are trying to buy electric vehicles. All right, two more slides, then we are going to get to your questions. In addition to tax cuts, in addition to perpetuating the Tax Cuts and Jobs Act 2017, in addition to the Donald Trump on the stump new deductions, the One Big Beautiful Bill Act also makes a number of spending cuts or spending reductions, depending on which side of the aisle you want to be on, to what nomenclature you like for that, that come into play. The Congressional Business Office estimates these new spending reductions at $1.3 trillion in spending relative to the baseline that pre-existed it over the next 10 years. And they come in three big places. Number one, cuts to Medicaid. There is a reduction in outlays to Medicaid, but they're now going to be attached to restrictions on eligibility, increased working requirements, expecting to get able-bodied adults off of the Medicaid rolls. There's going to be more frequent checks of eligibility and stricter verification. The theory here is to get people who qualify for Medicaid but should be doing something else for their health insurance off of Medicaid. And that is estimated to reduce spending by $700 billion over the next 10 years. Cost to the Supplemental Nutrition Assistance Program, SNAP, otherwise known as food stamps. Again, a stricter eligibility and verification process. Barriers to able-bodied adults leads to lower SNAP spending over time. Expected to reduce the outlays for SNAP by almost $300 billion over the next 10 years, $295 billion according to the Congressional Business Office. And finally, the Affordable Care Act. The One Big Beautiful Bill Act does not impact the Affordable Care Act itself, passed in 2010. Instead, it affects the American Rescue Plan Act of 2021, the big Biden COVID spending bill from March of 2021 that created these enhanced premium tax credits, which were going to expire anyway, as I understand it. And OBA essentially it chooses not to renew them or chooses to let them expire, or it does make them expire within the year. Exactly what that mechanism is, I'm not quite sure. But that reduction of these enhanced premium tax credits that came from the Biden administration in 2021 is expected to reduce spending by about $130 billion over 10 years. Add that all up, you get close to that $1.3 trillion. There's various other odds and ends. Well, to give you a little bit of current events, I don't know who's noticed, but the federal government is currently shut down. And they're shut down specifically over the spending cuts contained inside the One Big Beautiful Bill Act. They center on this. The Senate Republicans need the support of 7 Democrats. They need to pass an appropriations bill, which is not eligible for reconciliation, not eligible for the Byrd rule. Therefore, they need to get past the filibuster, and they need 7 Democrats to give them the 60-vote majority to get to cloture and get past the filibuster. This is the first instance of positive leverage for Senate Democrats probably all year, probably in 2025. And the Senate Democrats, supported by their colleagues in the House, have decided that they are going to use this leverage as a time to attempt to reverse all of the spending cuts in the One Big Beautiful Bill Act. I think that was their opening volley, that all the new Medicaid rules must be repealed that were in OBA. The Affordable Care Act tax credit expiration must be reversed, and those must carry into the future. And other spending reductions from OBA must be reversed. Senate Republicans in the White House seem unlikely to give in to that demand. Currently, we're on day 6 or day 7 of the shutdown, and it continues to march on. So stay tuned to what happens with that. But the One Big Beautiful Bill Act, not just a tax cut, but also a spending cut, $1.3 trillion, and the fight over that continues right now. There are other things in the One Big Beautiful Bill Act I haven't been able to cover here. It is a very large bill by its own name. It's very big. I would encourage you to seek out the LBMC blog post that talks about the One Big Beautiful Bill Act, or subscribe to the Navigator. We're going to get a Navigator newsletter with that as the primary article sometime in the next couple of weeks. Thank you, everyone. Thank you for your time today. I hope this was a chance to learn a little bit more about the One Big Beautiful Bill Act. Have a nice day.